Good afternoon to our CLA family members, clients, community partners, and friends. Welcome back to our live stream. I want to give a brief overview today of our session and welcome our presenters. As we said Tuesday, we had some big news with respect to the Main Street Lending Program, where they expanded the program to allow more small and medium-sized businesses to be able to receive support. Todd Sprang will cover these key points for us today. Just know that that program is getting up and running, and the board expects the Main Street program to be open soon for lender registration. We also are thrilled today to have Paul Neefer on the show to spend some time with us talking about the impact of COVID legislation on the agribusiness community. Paul is a principal from our Walla Walla, Washington office. And for those of you who don't know him, he authors a blog, Farm CPA Today, that can be found at claconnect.com. Finally, last night, the Treasury released a new IFR related to the PPP. We have brought back Jack Rubicki to talk about this and to continue unpacking not only the recent PPP developments, but also more frequently asked questions related to forgiveness and planning strategies at the end of the session. So welcome to the three of you. Now, before we dive in today, I would like to cover an important point. We are saddened and concerned for each person who viewed inappropriate chat statements on Tuesday. In response to that, we have created a more safe and secure environment for you to participate in the conversation with us and continue to ask your questions. Please submit questions throughout the session today using our email address, livestream@cla.com, which should be running along the banner of our screen. And we have CLA family members that are monitoring that inbox and directing questions to us so that we can answer them throughout the session today. Also, as with prior sessions, we'll post those frequently asked questions on our website as a follow-up to the session. So with that, I'd like to start today with Todd and start by discussing the Main Street Lending Program changes. Todd, thank you so much for joining us on these important points.
Thanks, Leslie.
So in the introduction, I alluded to the fact that the Main Street Lending has had several developments. Can you go over just what are the important developments and then what do those mean for borrowers?
Sure, I can do that. And as I analyze those changes and the others to date, I think if I started going into the details of some of those changes, it could probably cause more confusion than versus providing clarity. So what I did was I went back through the modified program terms as they exist today, because that's, I think, the challenge of what you'd have to do if you're evaluating Main Street lending as a funding source. And I went through those facilities, and I'll summarize those so that you can evaluate what they look like today. All right. So I'll start with that. And when I looked at the basic terms, some of the parts of the terms remained unchanged. So the interest rate is still 1 to 3 month LIBOR plus 300 basis points. And you still have the ability to prepay these Main Street loans without penalty. But the overall term went to 5 years, with the fee, though, still paid by the borrower. So for loans, for example, on those fees paid for the new and the priority funds, those fees will be between 100 and 200 basis points, because the base fee is 100 basis points, but the lender has the option to pass along another 100 basis points for those facilities to the borrower. But really, when I looked at it, there was a combination of those changes you mentioned before result in some differences in cash flow out from the borrower to the lender in those instances. So if you look at that 5-year term, now year one is no cash outflow from the borrower, no principal or interest payments. However, interest continues to accrue. It's just capitalized and tacked on to the principal amount on the loan. Then when you transition to year two, then interest accrues, but now interest is paid by the borrower in accordance with their loan agreement. And in that, it was a little vague. So it seems like there is some ability for the lender to determine the frequency of those interest payments, but they will be more current on interest payments than before. And then years 3 through 5, those payments are made at the end with respect to principal, which includes capitalized interest. those payments will be made at the end of each year, with the payments more heavily weighted toward the third year. So say 15% in year 3, 15% in year 4, and 70% in year 5. So what it's done is that program's not only extended the term, but I'll say delayed the cash flow payments from the borrower to the lender. There were also a couple important size considerations that changed with these changes that you mentioned. By lowering the minimum loan sizes for the new and the priority facilities, it allows more entities to meet those loan sizing criteria. So those with low EBITDA who couldn't meet those old $500,000 loan amount minimums might now have the ability, now that it's lowered down to 250. So when you take a really low EBITDA with the multiplier, and if you had some minimal debt, you could still meet those minimum thresholds, where many times when borrowers were asking questions in those calculations, they were coming up with maximum amounts of borrowing that were below the program minimum. So hopefully that helps. And then raising some of the loan maximums provides relief to those who might have been limited in their borrowing because they had to consider affiliates. And the FAQ states that in no case when you could the affiliate group's total participation in a single facility exceed the maximum loan size for that entire affiliate group that is eligible to receive funds on a consolidated basis. So as a result, when you looked at it as an individual borrower, your maximum loan size could be limited by your own leverage or the leverage in your affiliated group on a consolidated basis, or the size of any loan that was extended to other affiliates in the group. So raising those maximums was good. And then when it comes to loan sizing, here's one additional consideration. It's beneficial for those, the loan sizing is beneficial for those that have been negatively impacted this year because it's based on historical information, historical data from 2019, or if that's yet unavailable, 2018. That's not as useful to those who in this environment have experienced increased operations, and that's the source of their need for cash flow. Since it's based on those historical multipliers, it doesn't really help them that much.
Well, that's a really good overview of some of the changes. So certainly with all of these lending programs, eligibility has been a huge concern, and you touched on it a little bit with some of the affiliates, but could you recap what the common eligibility questions are with respect to this program?
Sure, I can do that, Leslie. There are 7 eligibility requirements, but most are straightforward, such as you look at the requirement when you're including affiliates to determine if you have less than 15,000 employees or revenues less than 5 billion. Recent questions have tended to center around the definition of what does it mean to have significant operations in the United States. That has been one of the common questions that has come up. And so the FAQ does provide the following examples to help answer that question, although it's not exhaustive, so don't consider these all inclusive. There could be other considerations, but it says you look at are 50% or more of the eligible borrowers' assets located in the United States, or is 50% of their annual net income generated in the U.S., or annual net operating revenues generated in the U.S. above 50%, or when you look at their annual consolidated operating expenses, excluding interest and other expenses associated with debt service, are those greater than 50%, or 50% or more of those generated in the United States? So that's helpful, but not all inclusive. But at least that gives some guidance there. And then on the other question that comes up is, what if I'm an eligible borrower, but I'm a subsidiary of a foreign company? And they do qualify. But I will say, when you look at that, the eligible borrower that's a subsidiary of a foreign company must use the proceeds of Main Street only for the benefit of the eligible borrower, its consolidated U.S. subsidiaries, and other affiliates of that eligible borrower that are U.S. businesses. So they're not supposed to use those proceeds for the benefit of foreign parents, affiliates, or subsidiaries.
Yeah, and that seems to be in line with a lot of the rules that we've seen related to global organizations and how the economic relief applies to them. So thank you for clarifying that also for us. So if we consider some of the other things, let's talk for just a moment about lenders that are going to originate the loans, and what does the relationship look like between the borrower, the lender, and then the Federal Reserve?
Sure, I can address that because it's different than some of the other programs. When you consider what the lender does under this program, the you would expect that not all lenders will participate in this program. I think we've said that on prior broadcasts. But the lender has certain roles and responsibilities in this process. They're going to determine the definition of adjusted EBITDA, and they're going to apply their underwriting criteria for the borrower. So if you went to, unlike other programs, if you went to various lenders, you might get slightly different answers on what your eligible loan amount might be, or their assessment of your underwriting. The lender will play, I think, in this in this funding source, a role of addressing the issues of subordination and some of the interaction with other existing debt, because they need to make sure that that's in order to pass this through or sell the participation to the Federal Reserve. The lender is going to originate the loan, but like I said, 95% of this loan is going to go to the Federal Reserve. So they're really going to be the holder of the majority of the note. But the lender will continue to execute on servicing. So they're going to collect payments, and they're going to collect the data that's outlined in the instructions from the Federal Reserve. And that's pretty significant, because if you look at that, the reason for those significant data requirements on either a quarterly or annual basis is related a lot to the fact that since you have such a long deferral period of no principal or interest for year one and just interest in year two, you need a lot of data to try to monitor the health of the borrower. And so what's going to happen is then the lender is going to pass that information over to the Federal Reserve, and they're going to monitor that information that they receive from the lender. And that may dictate how they transfer ownership, how much they retain, or what they may do with their ownership based on their managing of that balance sheet. But that doesn't mean, while they will have some influence or ability to step in collection processes, it doesn't mean that they're going to ultimately step in immediately in situations of default. So I think the lender still will play that role, but the Federal Reserve will have an oversight role and could step in. I think they mentioned specifically in some cases of bankruptcy or large loans where they might step into those collection processes.
Well, certainly a complicated relationship between all three parties. And thank you for clarifying what have been the changes to Main Street lending. I think it's going to continue to gain relevancy in the coming weeks, and we look forward to continuing to have you back as we learn more details about that. So we'll keep you around in case we've got some questions that are coming in through the live stream email box. But at this point, I'd like to pivot and bring in Paul Nefer. So just a little bit of background here. Certainly PPP, EIDL, and all of these economic relief issues have been really hot topics, and agribusiness has some especially unique applications with respect to economic relief. So, Paul, we are thrilled to have you here today to address these issues.
Thanks, Leslie. It's great to be here to talk over those situations.
So, first of all, thank you so much for your thought leadership and all of the information that you provide to us in the blog. I wanted to start by asking if you could walk through a couple of the key bullet points for PPP specific to the ag industry, as you've had a ton of activity there as you've been blogging this whole journey.
Yeah, I think one of the first things to understand is the SBA really doesn't understand ag. That's coming across pretty loud and clear. And agriculture is pretty unique on how they pay their employees. Most other industries pay their employees by writing a check. In agriculture, sometimes they write a check, sometimes they actually provide a commodity such as corn or soybeans or milk or something else. And in that situation, the farmer may have gotten a loan, a PPP loan, based on that commodity wage, but according to the application, you actually have to pay that employee in the form of cash or write a check to them. So ag producers need to understand that they actually need to write a check to their employees. Also, a lot of, especially in the livestock industry, actually provide housing to their employees. It's a tax-free fringe benefit. But again, according to the application for forgiveness, none of that's going to qualify unless it's actually included as part of the compensation of that employee. So those are some of the things that are very unique to ag.
Yeah, and that's very interesting. It is unique to that industry, and you can understand how, to some extent, they've put that in there to do some tracing, but certainly I think it really creates some operational considerations. There's also been requests in your blog and from various folks that you cover self-employment for PPP matters. You know, the first interim final rule on April 14th limited forgiveness for self-employed individuals to just 18 weeks worth of net profit. So it created this real conundrum because self-employed individuals were concerned then whether or not they would get forgiveness for the payroll costs for any employees that they had, or even any non-payroll costs, rent, utilities. The May-June IFR seems to allow payroll costs for employees that are under a sole proprietorship, but I don't know if I'm misreading that IFR or what your interpretation is, being really ingrained in the industry.
Yeah, and I think with the fact that we do have a new bill, we really need to wait for that final guidance, or we shouldn't even use the word final. I think it's final until it's changed. Yep. Guidance on that. But it looks like, based on the PPP Flexibility Act, that likely those farmers should get 24 weeks of 2019 Schedule F compensation. And again, that's related to their owner compensation. On top of it, they should get credit for any payroll that they actually pay. And they also should get credit for interest on mortgages, rent, and then the utilities. Now, as far as which utilities count, you know, we still have that discussion on gasoline, diesel, and so on. Is that really a utility? I don't think anybody really knows that for sure yet, but that we should get positive news on that fairly quickly.
That's an excellent overview of those points. Let's also talk just for a moment about self-employed farmers. Typically, they don't pay themselves. So in terms of tracking forgiveness for their income, what do you recommend that they do?
Yeah, and if you look at the interim final rule, it doesn't appear to require them to pay themselves, because typically as a sole proprietor, you don't get paid. You're not an employee. A lot of times you just reinvest all those funds back into the farm or back into that operation. However, again, on the application, which is what the banks are really going to look at, SBA is going to look at, it does require documentation as to you are paid for that owner compensation. So whatever that component is, again, based on 2019 Schedule F income, you need to go ahead and actually write a check to yourself. Now, I think to some degree you could deposit it back into the same account, but you physically do need to write a check, at least for that owner compensation portion.
Well, we really appreciate all of these insights that you've provided our audience, and we thank you for joining us. We'll also keep you around so that as we're monitoring the inbox, we can address any questions that are coming up. So with that, I'd like to now pivot the conversation to Jack and talk a little bit about some of the changes and other FAQs that we're seeing related to the PPP and the new IFR. So Jack, welcome back.
Hey Leslie, great to be back.
So Jack, we received another new IFR last night, so I figured why not start with that. What are some of the highlights that we've gotten from this most recent IFR?
Yeah, so this one's just like Christmas every day with the Treasury and the SBA, it seems. So most of what we got in this was just really starting to take the PPP Flexibility Act and move it into the rules, which are in the form of IFRs or FAQs, right? And so what we really got here was some basic stuff about, okay, we now have a 24-week covered period, but you can still elect the 8 weeks if you had your loan out there. Also, for new loans, you do now have the 5-year maturity date on new loans, and that existing loans, if you can talk to your lender, you guys can have a conversation about potentially extending that as well. Also talked about the deferral period. And so that was one of the new things that's out there. And, you know, the IFR itself really clarified this one for us. So under the new deferral period, you no longer have to start servicing the loan until the SBA pays the lender for forgiveness. And if you, as long as you submit an application within 10 months, that's kind of your new trigger. Now, if you don't submit an application for forgiveness within 10 months, then after that period lapses, then you have to start servicing your loan. It really didn't address, though, if that applied to all loans or just new loans or what. The IFR clearly stated, though, that this is an amendment to the CARES Act itself. So this change is retroactive back to March 27th. So that means that those provisions on the loan deferral terms go back to all loans that are out there. Now that's going to wreak havoc with the banks, because every bank that had a loan document started their loan amortization 6 months after the origination of the loan. Now we've got revised terms, and if you think about it, if you have take a 24-month period or 24-week period, and then you add 10 months on top of that, and then you also get the time for processing, you could be up to 15, 16, 17 months before you have to start servicing your loan now. And that's just going to, wreak havoc, because you still have a 2-year term out there for those original loans. That did not change, right? So those are, some of the main things that were included in there. The other big one, though, that we got clarification on had to do with the application of the 60% payroll threshold, right? That was one that concerned everybody. Was it a cliff or was it not a cliff, right? And we got some good news on Monday when there was a joint press release that was out there, but this actually codified it for us, right? And it did clarify that this 60% test is not a cliff, and it really is going to be dealt with as a proportional reduction. So think about the way the old 75-25 test was applied, that 75% of payroll had to be forgiveness had to be on payroll. Now you can just substitute 60% and 40% for those two numbers. And so, when you're trying to figure out your maximum forgiveness now, you'll take your payroll cost, divide that by 60%, and that'll set your new potential threshold. So that was great news to hear, because we were definitely concerned. We knew that they had stated they were going to take care of it, but that was one that they took care of, very quickly in the process.
Those are some great updates. It's fantastic to see that we've gotten some clarity on those. And certainly for every time we get clarity, I think, there's also more questions created, as well as some things that perhaps weren't addressed that we had wished were addressed. So what are some of the areas that are still not addressed or clear based on this?
Yeah, there's really, the one main area that we're hearing a lot of discussion about is, does the extended covered period give us a higher cap on what we can pay to our employees during that covered period, right? Our expectation is that the answer to that question is yes, right? If you look at the construct of the CARES Act, that 15,385 number doesn't appear in the CARES Act anywhere. That's a calculated number based on the formula that's laid out in the CARES Act that says 100,000 annualized, prorated for the covered period. However, with that being said, what has happened is in the application that Paul referenced earlier, that number is actually physically input into there as a cap. It's not a reference to a calculation. It says 15,385 is the most you can put in for this line item. And so while we think that, when they update the loan application and the loan forgiveness application, those are going to get conformed to the new calculated numbers, there can't really be any assurance that that'll happen. But, we feel pretty comfortable that that's going to be a conforming change, because that would say that the application would actually be in conflict with the law, which we don't think is going to be the case. So we expect the cap to raise to 46,000 and change. But that's one of those things that I wish they would have addressed in this last round for sure.
Yeah, that's good to know, and certainly hopefully will be good news for us. In addition to the IFR being released yesterday, we also know that there was a Senate Small Business Committee meeting that happened yesterday, and certainly, while that's not law yet, it does tell us perhaps what some folks on DC on the Hill are thinking. So can you tell us what we learned and what we heard from that session?
Yeah, it was quite an interesting session to watch. I think at the end, Marco Rubio said it was probably one of the first sessions where they had full attendance. So it was even their group was enthralled with the discussion. So a couple main things that I took away from that. There was broad support for, we'll call it a round 2 of PPP, meaning that for companies that had already got a loan under the Paycheck Protection Program, but were getting close to exhausting those funds already and really still aren't ready to be up and running on a full-scale basis again, could we get them some additional funds, right? So Senator Collins, for instance, used an example of a restaurant, and she said, look, they need more money at this point. They're out of money. They need, to go back to the trough again. So could they go back and use some of that $130 billion that's still there to be allocated? Could they reapply or potentially just get an incremental 4 weeks onto her loan? And Secretary Mnuchin, was very clear. He's ready to act very quickly on this, depending on the direction he gets from, Rubio as the committee chair, and then Senator Cardin, the ranking member from the Democrats. So he said on multiple occasions, if you guys give me a letter and say, this is what you want to do, we're going to make it happen the next day. So we're not sure when or if that's going to happen, but there was a clear consensus around that. One other thing that was really interesting, and again, this came from Senator Collins' questioning of Secretary Mnuchin. She asked a question about, well, when can people ask for forgiveness? Now, she did use that in the context of, we've got people that are likely going to use the 8-week period. Do they have to wait till the end of the 24 weeks? And we didn't think you would have to there, but Secretary Mnuchin's answer was pretty interesting. He said, no, those people should apply, as soon as they can. He goes, but whenever you use your money, you should apply for forgiveness. So now there's a question out there. Well, is it a 24-week period, or maybe is it up to a 24-week period? And, if you use all your money after 12 weeks, can you apply then? We don't know. And so, but it opened the door, and now we've got a lot more questions as usual after one of these kind of events.
Yeah, so certainly that's a public statement. We can't get too carried away with that. But what it does put us in a little bit of conflict with is if they can do that forgiveness right away, but then we've got to measure FTEs at the end of the 24 period, how we do that. So more to come probably on that. Yeah,
for sure.
So that's a great bit of updated information. Anything else you want to cover with respect to this program?
Yeah, there were really 2 other items that got a lot of discussion during this as well. One was just the application process itself, and nothing against us accountants or the attorneys, but it's obvious the senators don't like us very much, and they made a comment out there that basically said, the people that are asking for forgiveness shouldn't have to engage a myriad of attorneys and accountants to do this application, and they want a simplified form for forgiveness, right? And Secretary Mnuchin, in his view, said that the new safe harbors that were put in there about having to rehire only by December 31st of this year, or demonstrate that you can't fully open before December 31st because of restrictions that are out there, that he anticipates that a lot of people will be able to check the box on those safe harbors, and as a result won't need to fill out most of the form. And he also said that he thought that because of the 24-week period now and those safe harbors, that he's anticipating, a significant amount of these loans are going to get 100% forgiveness. Now, that was a little bit contrasted where in Senator Romney's kind of cross-examination or discussions with him, where Romney brought up the whole concept of the income test or the revenue test. What about companies that, weren't impacted adversely by COVID and didn't see a decline in revenues during this period? And we got some insight into that. Both Senator Rubio and Secretary Mnuchin talked about the fact that was deliberated, that they thought about putting in a revenue test, but then ultimately decided it wasn't the right thing to do, that too many companies would be impacted by it. It hadn't been disclosed on the front end. Now, what Secretary Mnuchin did say, though, was that he had hoped that a lot of people would self-select into not requesting forgiveness, right? Because he would say that, there is that term in there that says you needed this money to maintain your operations. And so in his view, he thought that, well, if you didn't have a decline in revenue, did you really need the loan to sustain your operations? And if you didn't, then you shouldn't ask for forgiveness, right? So he's hoping that people self-select into that, but that was the reason why they didn't put the revenue test in there, and likely we will not see a revenue test. I didn't get the sense that that would be something they'll add going forward.
Well, those are some really interesting perspectives. I'd like to take time for a couple questions that we've gotten from the inbox. The first one I'd like to direct to Paul. It's a really interesting question related to losses on the 2019 return. So Paul, the question is, can a farmer apply for the PPP loan if they didn't show any income in 2019, or they basically had a Schedule F loss?
If they have a Schedule F loss, they can still apply for a loan. They're just not going to get any loan amount based on that loss. And what I mean by that is if they have employees, that's the key. If they have employees that, let's say they paid their employees a total of $60,000, then essentially they'd probably qualify for about a $12,500. I guess I could get that right. So that's the key, is you got to have wages that were paid to employees. If you show a loss, you're going to get nothing for your, quote, owner's compensation.
Well, I think that's really good news, though, so thanks for clarifying that. I want to stay with one other question that's similar to a loss, and that is the question of negative EBITDA and how that might impact Main Street lending sizing. So Todd, can you comment on that? Because we've seen a lot of questions on negative EBITDA.
Yep, sure, I can do that, Leslie. Quickly, unfortunately, even with the lower minimums, if you do your adjusted EBITDA calculation in accordance with the lender's standards and you don't meet the minimum loan requirements, you do not meet the eligibility requirements for the program, and you wouldn't be able to participate. So even though they lowered them, if they didn't get them low enough for you, unfortunately. But there will be other programs. They allude to other programs available for those that are more asset-based or others that wouldn't qualify because of some of those EBITDA requirements.
Excellent. That's very helpful as well. Jack, let me ask you one question about the PPP that we've been seeing. Certainly everybody's got questions about allowable costs versus not. Some employees have been getting technology allowances now because they're working at home and companies are covering that. Would those be considered allowable costs?
Yeah, we think most allowances that ultimately will be included in your W-2 wages are going to be an includable wage, right? And it would be all subject to that $100,000 annualized cap, right? So no different than a cell phone allowance or a car allowance or anything else that you would pay that would be included in gross wages. If the technology allowance is treated in the same manner, we do think that that would likely be includable, again, subject to that cap.
That makes a ton of sense. Well, I would like to thank all three of you today for participating. Unfortunately, that's all the time we have. We would like to remind all of the viewers to continue to visit our COVID landing page at CLAconnect.com for more PPP forgiveness application information, as well as any other hot topics that we have. And you can also just take a moment to subscribe to our emails using the link provided below. And that'll allow us to continue to share up-to-date information around forgiveness, including demos of the tools and all of the other good information that we're providing real time related to COVID and the legislative developments. Please continue to send us questions, and we look forward to joining you all again next week. Have a wonderful afternoon.